This is Rich Pawson. It's December 9th, 2018. This chart is an interest rate chart of the 30-year T-bond. And you can also apply this analysis shown on this chart to the 10-year note and other interest rates. Let's talk about supercycle trends first. And back in 1946, there was a supercycle low, which is not shown on this chart. We had a supercycle bull market into 1980. Most of this uptrend was actually early inflation and a good thing. Then it evolved into late inflation, became a bad thing, and the Fed Reserve realized the entire trend or the mechanics or machine behind this trend was going to self-destruct. It was going to hurt the economy. And so they went into a mode of fighting inflation. And so we then saw Paul Volcker come in. Now we also saw the symbolic election of President Reagan towards a pro-business concept, towards produce more and more, cheaper and cheaper kind of concept. And we also lowered interest rates, and the Fed worked along with that. So we started a disinflation trend. We started a supercycle bear market in interest rates, and most of this downtrend or bear market was early disinflation, which was a good thing. But just as inflation evolved to something bad, disinflation normally evolves in something bad. So the late stage of disinflation can lead to a deflation depression, and that's exactly what the Fed recognized and hired Ben Bernanke. And we also, of course, saw the financial crisis and the Great Recession, and the Fed lowered interest rates fast enough to try to help out with that and keep the money system going. At any rate, we are due for a supercycle bottom in interest rates around 2020 to 2021, and then we'll see a bull market. Now, as far as this bottom that's coming, ideally the recent low shown here would be violated. I don't think we have an ideal situation right now. I question if we will see no lower interest rate than what's shown on this chart. Perhaps we'll see the Fed dip back to 0%. They may only come back partially. So I think we've pretty much wrapped it up, and I'm looking for truncated lows, if you will, secondary lows to coincide with the supercycle bottom. And then it's going to be a bull market into the 2030s for interest rates, therefore bear market for bonds, of course. Now, in the past, I would have thought that we're probably going to put interest rates back up into that 15-17% area, back to that 1980 high. I don't see that. I see a paradigm shift in our economy, the machine, the mechanics of how things are working. And I'm thinking it probably doesn't go any higher than, say, 7.5%. 10% is another very strong resistance level. And I can also see this could be a more struggling trend, nothing like this minimum variation bull market. It could be more of a struggling bull market. And the fastest, most intense rise in interest rates could wait all the way to the 2030s for some kind of little blow off top. So that's my supercycle scenario. Now, the supercycle breaks into 9-year cycles. Bottom to bottom, they're actually 8 to 13-year cycles. And if you're using the Schumpeter model, that's similar to the juggler cycle. Okay. Now, the 9-year cycle is a component of the supercycles, but I believe it breaks down into a 6-year cycle. It's actually about 5 to 7 years. That's just a name. And then it breaks down into 3-year cycle, which is actually 3 to 4 years. And on the juggler model, Schumpeter model, it's called the kitchen cycle. Well, I believe a 6-year cycle, along with a 3-year kitchen cycle, will top for interest rates in 2018 to 2019. And then interest rates will decline into this 3, 6, 9, and supercycle lows, and with a recession. So this is backing up the macro and the stock market forecast for bear markets and a recession coming here for the economy. So now it's just a question is, did interest rates top in 2018 or 2019? And I could see one last jump up and during 2019, even though the Fed may only raise its rates once or twice instead of 3 or 4 times. I can just see the free market system perhaps putting it up there. But right at the moment, the data is crazy. It's flaky for everything. The economy, commodities, stock market, all this trade war, the geopolitics. Tricky situation here. But I'm watchful for a peak in interest rates 2018, 2019, then a decline into a recession, and then on to a supercycle bull. Thank you.